Hello and welcome back to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, Head of UK Rate Strategy, and I'm joined today by our global market specialists, Nevruzi and Joann Spadigam. Okay, lots to catch up on literally this week, given we've been off for so many weeks. But given it's the ECB next week, Joann, I will start with you and your views on Europe. Before we took our extended break from Bondcast, it felt like European markets were taking a little bit of a backseat to other fixed income markets, or certainly were being driven, I suppose, by what was happening in the US and the UK. But we have seen a bit more volatility that's sort of been domestically driven, I suppose, in Europe over the last couple of weeks, and particularly around expectations for next week's meeting. So what's been driving that, and how does that fit your views?
It was a fairly quite start of the summer, like you said, but we've had a fairly interesting couple of weeks with lots of data really driving the market. It does seem to me, at least, that there's some nervousness in the market about what the ECB September meeting could hold, whether that's a hike or pause. We're in the pause camp, but we'll come back to that later. But I do think that in terms of the ECB, the data dependency message has really been resounding through the market, and we've really seen the market react in response with that data dependent message. On the growth picture, we've had PMIs come in, and to be honest, they were a lot weaker than markets were expecting, which did lead some repricing for the September meeting on the back of those. The story there really is that the weakness we saw before the summer in the manufacturing sector is now not just contained to the manufacturing sector, with the services sector as well showing signs of weakness. So we've seen the PMIs come in sub 50, so indicating recessionary territory for both the manufacturing and services sector. So this story for growth in Europe really is not a positive one. We've seen revisions downwards in the GDP picture today. I think, just generally speaking, I think there is this understanding that European growth is going to be slow, and that's kind of what we've been seeing or playing into the dovish side of the, argument. On the inflation side, the numbers we saw last week were fairly interesting in the sense that headline inflation did come in slightly higher than expected, but core was in line. And I think the core inflation print is interesting because it does show that there is some kind of gradual easing in the core side of things, which should obviously be positive for those in the committee hoping for a pause in the next meeting. I think the inflation picture, of course, has a lot of uncertainty at the moment. We've had energy prices in focus once again in Europe. We also had, I suppose, the inflationary headline data last week, which came in a bit higher than expected. But for us, we do think that inflation should continue to come downwards, particularly for the next print that we get after the ECB meeting. So the inflationary pressure really is also kind of moving inflation lower, whilst the growth picture is stagnating as well. So I think all in all, the data has kind of supported our view. But I think another sort of interesting driver has really been in terms of the ECB speakers we've been seeing of late, with markets kind of pushing high and low based on what we're hearing from that. For me, I think the kind of main point we're getting from both the Hawks and the Doves is that the next week's decision is open for either a kind of hike or a pause. But I suppose the movement in some of the Hawks, for example, Schnabel, leaning a bit less hawkish than before, did kind of move markets to reprice the September meeting, whilst yesterday not coming in saying, oh, markets, maybe you're pricing too little, led to another repricing, this time upwards for the September meeting. So I think there's just a lot of volatility, and markets really are being reactive to a lot of the things that are coming up.
How has that left your view then? I suppose here I'm thinking both in terms of, well, rate action for the next meeting, but perhaps what that implies as well for peak rates and whether we've reached that or not, but then also how you're thinking about QT, as that's another tool that the ECB can react with.
So our expectation for September hasn't really changed. We still expect a pause next week. And I think the deterioration in growth outlook really does solidify that view for us. Decreasing and deteriorating growth picture has implications for inflation as well. So that obviously leading to potentially weaker growth and then weaker inflation as a result. So for us, the clear answer, at least for next week, is that there will be a pause. We obviously know that there's a risk that the ECB might actually hike as well. So I do think that where markets are pricing in at the moment at around 35% chance of a hike, does look around fair to me, given the risks that could actually materialize. But I don't think that the ECB will use QT, for example, as a negotiation device between the hawks and doves, for example. I think active sales in Europe is obviously a lot more difficult given the range of assets and the range of country bonds that the ECB holds. I don't think now is the time for them to be thinking about that, particularly given that they only really started to get comfortable with BTP QT quite late into the process. I think if there were to be sort of a negotiation tactic, it could come in the form of minimum reserves, given that there was a change in that last time around, and given that the kind of minimum reserve requirement, which is 1%, has actually been high in the past. So we could see that, if anything, as a kind of tool for negotiation.
When we think about the next meeting, I suppose this goes back to how we would talk, the kind of language that we were using when we were talking about the Fed a couple of meetings ago, whether they hike or not, is that a pause or a skip? How are you thinking about that? If they don't hike next meeting, do they deliver this as a skip, or that the peak is actually in?
I do think that any pause next week will kind of come with this, a narrative that the ECB will be open to doing more if they need to. That being said, I do think a pause next week also reduces the likelihood that they do more, in the sense that if there isn't a reason to hike next week, I think the reason to hike in the next and upcoming meeting will be even lower, given that we do expect that the next inflation print will come in a lot, will kind of show a decrease once again, driven by services and also goods inflation coming downwards. So with the inflation picture moderating, I do think if they pause next week, then another kind of skip narrative or hike in the future is more unlikely at this stage.
Okay, great. Thank you. Well, we will obviously catch up next week after the meeting when all of our questions have been answered. Okay, Jan, over to you then. There's also been, I guess, unsurprisingly, a bit of volatility in US rates as well, particularly since we last spoke. Broadly speaking, we've seen curve steepening come about with that volatility. What's your view on the drivers behind all of those things?
Like you said, we have seen a broader steepening, but this time driven by the long end of the curve, which is mostly unusual for this part of the cycle. But we actually did dig a little bit deeper into the topic and kind of find out that as the central bank pauses the sequence of hikes, or at least introduces a lot more uncertainty whether they are going to hike or cut in the future. Basically, what the Fed is trying to do with we're here, we're going to pause for a little bit, or at least we're almost here. That we don't think we'll get another interest rate hike, but markets are still kind of in a 50-50 mode. But the days of 75, 50 basis point hikes, and wondering whether we have another percent or 2 more percentage points left ahead of us in the hiking cycle are mostly behind us. So when that happens, the front end really tends to get pinned, or at least trained in a relatively narrow, well, for this cycle in absolute terms, not so narrow, but in a range. So the 2-year note has been trading around the 4.8%, kind of in that, it's similar to kind of in a wider with some fluctuations, but overall in that band, not that surprising. But then the long end became kind of like the more, and by long end, I'm talking about 10-year, 30-year, those parts of the curve did become a little less anchored, because you end up in a situation, like I said, until now it was very much so we either rally because markets don't think the Fed is going to hike as much or cut sooner, driven by the front end, and we sell off because of the other way around, we think we're going to hike more. Now that's been contained. A lot of the action has shifted further out the curve. We're having days where people are more worried about supply or growing deficits, or ideas such as a soft landing, which we think has taken a very strong kind of presence on Wall Street now, or generally across price setters, that the economy is suddenly going to avoid a recession, or in fact have no recession at all, a view that we completely do not subscribe with. But by any means, ideas like that tend to push longer dated premiums, such as people like talking about term premium or risk premium, or however you want to call it, these measures that you can kind of only observe ex post. For the sake of most investors and practical debates on markets, the neutral rate is mostly a bit of a arcane and useless, so I'm not going to get too much into it, but it sure makes like a good dinner conversation with economists.
I'm not sure what wild dinner parties you go to.
Yeah, no, between that publication and today, they haven't been that fun.
Okay, let's think a little bit about the Fed, I guess, a bit more near term and perhaps concepts that we are happier to put, actual estimates and numbers around. Obviously, the Fed isn't for another couple of weeks, but next week we do get CPI, which will be important in determining, certainly from a market perspective, determining expectations for that Fed reaction function going forward. How are you thinking about US CPI next week?
So we see it more or less in line with what the market has in at 0.2 on the core side, which is, as a reminder, strips out the food and energy components because it is widely expected that since energy prices like gasoline has seen rebound over the past month, or at least through August, that we are going to see a jump there. So that shouldn't be a surprise, but the core component in our view continues to take lower. Rents are moderating. You have across the board kind of like a normalization of prices. Goods are in deflationary territory for the most part. And like I said, this kind of drop in shelter and rent measures are expected and they're materializing. So if we see a little bit a continuation of that trend, we should get a firmer 0.2, which in our view is certainly enough to allow the Fed to take a break, certainly skip the September meeting. And skipping the September meeting is, to be fully honest, it's not really a contrarian view that we have. That is very well priced in. And we did see from most of the Federal Reserve speakers over the past week or so, kind of defending a similar stance. Maybe we don't have to do September. Maybe we reached the point of enough tightening. Maybe we haven't, but let's wait and see. And I think they're pretty much sticking to the script from the latest summary of economic projections, where the Fed had another hike left for this year. There's just simply no point in walking that back just in case inflation accelerates. We've had too many missteps, or the forecasting community, including them, had too many missteps in trying to get the path of inflation right. So there's just no point in having this confidence and saying, well, listen, it's mostly done. We think that can flip pretty quickly if we get a confirmation that trend inflation is headed lower. Then we certainly think the cycle could not only be over, but by the end of the year, we could start getting indications that as the economy slows down, that they might decide to kind of like pull back a little bit in nominal terms just to keep the levels of tightening in real terms unchanged, right? Because like if your inflation is coming down, and if you keep rates at 5.5% while your inflation is coming down, in real terms, you're passively tightening. So we think they would want to avoid that situation.
Makes sense. What else are you going to be watching in the next couple of weeks, except for the data, I suppose?
So corporate supply has been a pretty big topic this week, and particularly last week heading into this week, and most likely will remain over a few, at least through September. That's largely because August was a fairly slow in terms of supply by corporates in the U.S. That's reversing now. That is also one of the reasons why we see, that is also one of the main channels that Fed's rate hikes are playing through shrinking corporate margins. From the debt channel, corporations are now issuing at obviously at like higher yield levels, although given how compressed spreads are, it really hasn't been kind of as much as you would expect. But nevertheless, there has been already for the first few days of this month, we have seen a large amount of supply. The first day, I believe, the first working day of this week post Labor Day was about 38 billion just in a single day in corporate IG in the United States. So a substantial number. We're not having quite days like that anymore, but comparably high levels are still in play, and which is adding a little bit more pressure to yield, adding tightening pressure to swap spreads and so on. So that will be a topic to watch. Until then, the real determinant of how the Fed's going to develop going forward, I think, is the CPI next week, as you alluded to. We've had some labor market data, like last week's unemployment was a mixed bag. I think it certainly shows that things are cooling down, but perhaps not to the speed that you would expect. For example, just because before I came into this room, we had the weekly claims showing again pretty secularly tight labor market. So let's see how that unravels. But I think that's probably enough from the U.S. I'm just gonna toss you right back into markets. You just came back from your, was it 2-weeker or more?
3 weeks. 3.
So just put you right on the spot and kind of bring it to the front end of the curve where we've actually seen a decent amount of repricing. Those expectations have changed, not just in the US, but also in the UK too. So how does that all fit in with your views?
Yeah, and I probably should caveat by saying this is very like high level, almost from the outside looking in, because as Jan said, this is my first day back after a 3-weeker. So I'm a little bit rusty. I'm trying to catch up pretty quickly on what has been quite big front-end moves in the UK. It looks like we've done pretty much a round trip, a 50 basis point round trip nonetheless, in terms of what markets are expecting from in terms of peak rates from when we last caught up, which was just after the Bank of England, the August Bank of England meeting, when we had that kind of dovish reaction function shift. Since then, we had data that pushed almost entirely in the opposite direction. We had the stronger than expected labour market data, then stronger than expected inflation data. But against that, we've then had weaker activity data and central bank rhetoric that has kind of continued to push in this sort of we are near the peak direction. So I suppose the two high level points that I would make today is that although there's a lot that has been made around this kind of insistence from the BOE that I guess Hill kind of kicked off last week with his Table Mountain narrative, but has sort of been doubled down again by Bailey. Their insistence is that they are near the peak. They haven't said that they are at the peak. And I think there's a bit of a disconnect between what the headlines have been reporting and what they've actually said in their language. They've talked, as we knew back from the August meeting, that the peak was near. But I still don't think that necessarily means that the peak is in. And to the extent that the parts of the data that they will be looking at is really kind of, core inflation, the wage data, that has been the kind of strong parts of the data. And although it feels premature and kind of a close call, I suppose, around what the BOE will do at the September meeting, given that we still have another inflation print and labour market data next week, to the extent that we think labour market data can still be strong, and actually, given base effects, we see another marginal tick up in headline inflation this month. Against that backdrop, I think it's difficult for them to kind of decisively conclude that the peak is definitely in and that they've kind of won this fight on inflation. We talked previously about how much more concerned they sound now about labour market data. We did a quick kind of word count on the times that they referenced pay growth or wage growth or earnings growth in the August meeting versus prior meetings. And they talked about it 20 times in the August minutes versus just 12 in June. So there's heightened concern around kind of second round effects. And it feels to me like although there has been mixed data, the weak data has really been on the activity side and not what they've been monitoring for, I guess, the strength of second round effects of inflation. Against that, though, they have, like I say, been pretty insistent on this narrative that the peak is near. And even after we saw this kind of big repricing and outperformance of front-end UK rates over the last couple of days, given the narrative shift from the MPC, they haven't really pushed back against that. Bailey sort of doubled down on what Pill said rather than pushed back against the market interpretation of anything that Pill had said. So on balance, it does feel like a close call. And like I say, with two kind of key data prints ahead of the September meeting, it perhaps feels almost a bit early to call it, but probably would still fall in the camp of another 25 basis point hike at this point, which would take rates to 5.5. And that would probably be the peak. So that was always, since the last meeting, has been our base case. So that's not a change. I guess the biggest shift to the view is that we perhaps thought that maybe risks were skewed a bit more clearly to the upside. Perhaps you get 5.5 and then risks of 5.75. And I think those upside risks have somewhat diminished given the rhetoric that we've heard. And I continue to push back against market pricing of the idea that the peak in rates doesn't come until March. The market has long had this kind of late peak. And no matter how much in recent weeks or even months that kind of peak has shifted, the timing has always been quite late. And I still think that is the case. The market's sort of 80% chance of a 25 bip hike in September, which feels roughly fair, I suppose. But the idea that they will still be hiking in March when other central banks are, we think by then will have clearly taken their foot off the gas and the data will have turned perhaps more decisively, I think is perhaps where the bigger mispricing is.
Not too bad for your first day back, I should say. I hope you didn't do the work.
Thanks.
Yeah, I hope you didn't do the word count while you're on on your vacation with this morning. But
I didn't do any work, but it would be kind of worrying if I forgot everything after just 3 weeks.
Fair enough. Okay, well let's go further out the curve. And you had a 10-year target for gilts at 4.6%, and it does feel like a while ago, but we just blasted through that target and we've came back again. So fair to say it's been sort of volatile in gilt land as well. So what do you think going forward for that section of the yield curve?
Yeah, I think I just missed out on having a Bondcast to be able to gloat about that. So I'm glad that you mentioned it today, because we did reach that target, but then, like you say, we have kind of rallied back through that with the movement in front end rates. Nothing has changed in the last 3 weeks, unsurprisingly, around my view really on longer dated rates. I'm still very much of the view that, we can get back to 4.6%, but also that the risks are still skewed to the upside on that view. And so I haven't changed my view that I wouldn't really look to fade the cheapening in 10-year gilts until we got to 4.9%. I think that, in some ways, again, the US is a lesson in terms of once we reach peak rates, or we're much closer to peak rates, and we can kind of move away from this, are they hiking, are they not, is it 25, is it 50? The market can focus on other things. We can get a return of term premium brought about by these kind of supply risks in the UK, and the supply risks still loom very large against a backdrop of not a huge amount of demand. And I think that, the closer that we get to both the QT announcement in a couple of weeks at the September MPC, the closer that we get to the updated gilt remit and the autumn statement in a couple of months' time, all of these things can serve as a reminder of just how heavy the supply is going to continue to be. And also, I suppose, just a return of supply. Clearly, we had this indication this week that was relatively well absorbed, but the next few weeks we'll see a general return of supply, which will make the calendar heavier than it has been over the last couple of weeks. And we may well start to see signs of that kind of supply fatigue that I would argue we were seeing early in the summer weeks return. And the risk to me still feels skewed to the upside on the supply front. So despite a more, I guess, a Bank of England reaction function that appears more dovish, the data perhaps is still pushing in the direction of a little bit more tightening still to come, and upside supply risks. I suppose if we were to put those supply risks into context, around 30 billion of additional supply plus an additional 25 basis point rate hike from the Bank of England would both together imply about 20 basis points on our kind of fair value estimate for 10-year gilts. So I think the risks are skewed one way, and it won't be all that long before the market is focused on those risks. But plenty of time between now and then to discuss all of that. So that's probably enough for this week. It was very nice to have you both back and Bondcast back. It feels nice to be chatting about markets again, and plenty to discuss. So thank you both for joining me. Thank you to our listeners for listening in. And just a reminder that if you liked today's episode, please don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks. See you next week.